So in this video, I'm going to talk about my basic covered call strategy. Now, I'm not going to go over what an option is, what a call option is. If you don't understand that part, I would recommend that you check out my other video, What is an Option? There's going to be a link in the description, but I do go through the details of how options are priced and some examples of that in that video. But in this video, we're talking about covered calls, and I put together this basic strategy for generating additional income to your portfolio based on a covered call strategy. I'm going to go through each of these step by step in this video. Now, it can be said that you can expect around 1% additional income per month. So if you have a portfolio, let's say your portfolio is $100,000 invested in the stock market, perhaps you can generate an additional $1,000 per month to your portfolio from a strategy such as this. Now, it's not guaranteed, of course. And I'm not going to, I'm not your investment advisor, and I'm not going to recommend that you do any particular strategy, but let's just talk about how this kind of thing can be done. Now, it's also possible to combine this with a dividend portfolio. So if you have your $100,000 theoretical in stocks invested in dividend producing stocks, then you're going to collect that 4, 5, 6% a year in dividend income, plus this 1% per month in covered call income. So what is a covered call? Basically, you're selling a call option on stocks that you already own. And if you don't already own them, then you purchase the stock and then you sell the call option on that. Now, in exchange for the premium, which is non-refundable, the person who purchases the call option off of you can get the right to buy your stock from you at a specific price before an expiry date. So if you do this right, you're going to buy some stock. We don't know what your price is, but you get this at a certain price. Let's call it X. You can sell a call for some premium. That's your aiming to be 1% of the price of X. And make sure that if your call gets executed, that you're going to be able to get more than you paid for it. So the strike price should be generally above your cost. And then you get to keep the Y no matter what. So you'll make that profit if the stock doesn't get called away, or even if the stock does get called away, you should make a profit. Now, the downsides of this are pretty obvious. One is you're going to lose money if the stock declines. Now, you're going to lose money if the stock declines anyways. So if you buy the right stock and you don't mind holding on to it, if it's a longer term, medium term hold in your portfolio, then you're not going to worry about the decline in the price. But obviously, if your stock price goes down, then as a whole, as a short term strategy, you're going to lose money. That's the same as owning the stock. And what some people think is the bigger downside is you'll lose some of the appreciation above a certain level. So if the stock does outperform your expectations for it, then the person who owns the stock, the call option, is going to call your stock back, and you're going to basically have to sell it at a lower price. Now, I visualized this on this graph. The blue line represents just owning the stock, and the orange line represents owning the stock and selling a call on it. And so we can see that for any hypothetical stock, this is Facebook as the example, at $235, let's say, is your break-even price, the price that you buy the stock. If all you do is buy the stock and hold it, you're going to gain. When the stock goes up $1, you gain $1. When the stock goes down $1, you gain $1. And that's the blue line. But for the covered call, let's say theoretically that you can receive $20 from selling an option on it. Now, it's going to vary based on the option type, time, etc. But let's say you do receive $20. Well, that brings your profit anywhere above $215, let's say. So you can see on this orange line is always higher than the blue line, except at a significant increase in stock price. So at the 235 is where you bought it. If the stock goes above 260, then the option owner gains that benefit and you don't. So your profit sort of flat lines above a certain amount. But generally, if the stock price does anything but go down a little, stay the same, go up a little, you're going to benefit from covered call. The only thing that you really are you lose out on is if the stock goes up by a lot. So this is my strategy in a nutshell, right? So you're going to pick a good quality stock. You're going to look at the options chain to see what options are available to you. You're going to do some basic math to see if that's profitable, if it's within your price target. Then execute the trade. Then you have to sit back and wait. And this is probably the hardest part, is just to let the trade play out. And once every 30 days, come back, see if you can close out the trade for a profit and implement the next trade. So every 30 days, implement this, looking around 60 days out. So picking a good stock. Now I am not a, stock advisor, and you're going to have your own strategy for picking good stocks, but this is just a list of things that came to mind. A good covered call stock is going to be something that you don't mind owning. So don't pick a stock that you, if it ended up having to own it, you're not going to be too happy with that. One example would be Hertz. Hertz is a car company currently going through bankruptcy. The shareholders are expected to be wiped out. Today, you could buy Hertz and sell a covered call on it. It's still available to you. But do you want to be owning Hertz a year from now? Probably not. There's a good chance your stock would be worthless. So don't sell covered calls on stocks where a year from now you'd be like, man, am I still holding on to this thing? Also, on the other end, maybe you don't want to sell covered calls on your favorite stocks. Maybe, I bought Facebook at $15, right? I bought Tesla at $50. And if I still owned them, I sold those at profits. But if I still owned those shares, maybe I wouldn't be wanting my Facebook stock to be taken away from me. I would have some pride in picking really good company and a really good stock price. So make sure it's like if your stock got called away, then there's no emotion attached to it. You're not sad. You could always just turn around and buy the stock again, right? So think of it like that. Then you also want to avoid stocks that have very short-term focus. So right now we're in the middle of a pandemic, and there's a lot of biotech stocks that are going up and down, security stocks, travel industry is in a sort of down cycle, and then they're expected to come back, and just avoid that whole area. Look for stocks that, again, not only would you not mind owning a year from now, they're still going to exist and be profitable and everything 5 years from now, even if you don't own them. So avoid the hype stocks. Now, you are going to require a stock that has some volatility. Now, there are stocks out there that are typically, we used to call them communication stocks or utility stocks, where they don't really go up and down, in big swings. So maybe your local energy company, the telephone company, things like that. Every company is going to be different, but maybe there's going to be low volatility in some of those stocks, and probably you're not going to be able to get good income with those covered calls. So that's probably the thing with low volatility, is if the stock hardly ever changes price, you're only going to get pennies for some of these covered calls, and you're not going to generate that income that makes it worthwhile. And also, stock price is a factor, so don't think you can get Berkshire Hathaway A shares. You need to be able to own 100 shares of this to be able to do the strategy. So the example I want to call on is Facebook FB. Like I said, one of my proud moments was buying Facebook at $15. Now, here's a recent graph, moment in time. Facebook currently at $237. This is a 5-year chart. And as you can see, going back 5 years, Facebook has just sort of had a slow plodding growth. There's some ups and downs here and there. So early 2018, there was a dip, and then late 2018, and now in 2020, there's a dip, but it always comes back. And it's kind of the kind of stock where it's like I can't really see why Facebook wouldn't be able to make money. Advertising will always be a thing. They're a great platform to advertise on. I love, as an advertiser myself, I love advertising on Facebook. I'm not a stock picker. I'm not making a recommendation, but it's just a good long-term stock play. Now, if we look at the Facebook options chains, we can see that there is an option that is 60 days out. So the August 21st option, as I record this, is 63 days to expiry. Now, you could do the July options, but you might not get as much premium for that. What we want to do is buy the August options, and then a month from now, roll those to the September options, and a month after that, roll those to October. That would be the plan. So let's look at the August chain. Now there's tons and tons, there's dozens and dozens of strike prices, but we're going to look at something slightly above the current price. So the current price, it changes all the time, but as I took this screenshot, $239. So 240 is considered at the money. Anything below that is in the money, and anything above that is out of the money. So if we look at the options here, we have 240, that's right at the money, 245, 250, 255, etc. Now maybe we can look at the $250 strike price. The current price for that is $10.70. So you can buy the stock for $239 and then immediately sell a option at the $250 strike for $10. And you're going to get the $10.70 is yours to keep forever, and you'll get an additional $10 in profit from the rise in the price of the stock if the person decides to execute their covered call. So that could be a $20 per share potential profit, which is just under 10%, about 8%, I guess. Again, this is for the August timeframe. So to execute this, you would have to have $24,000 to buy 100 shares. You would collect the $1,070 from selling the call. Remember, it's times 100 for working with calls. Your net investment, so you take the price that you paid and the amount that you collected, you're going to get $22,914 as the net price. And if the price was to move to $250 by August 21st, your stock would get called away and you would receive an additional $1,016 profit from that. So here's the potential graph. We already reviewed this, but we can see at the $250 strike is where our profits top off. And we're generally profitable anything below $260. Covered call does well. And our where we start losing money has actually shifted. Let's see, it was 239 minus 10, so 229 is where you start losing money. So we're already started in on this to do the math, right? So there's the money you make from selling the call, which is the premium, and potentially the money you make from selling the stock if it gets called away. So remember, we said it was $22,914 for the net investment required. You would receive $1,070 immediately. That is a 4.6% return on capital over that 2-month period. Now, keep in mind that we are expecting to roll this trade if it doesn't hit 250 after about 30 days. So we're not going to receive this whole 4.6% after 60 days because we're going to have to then buy back some of that call. But let's say it could be 2% return on capital after 30 days. If your stock does go up, if Facebook does get to the $250 price, you might have to force to hold on to the call. You would be too expensive to buy it back. And after the 60 days, you would receive a $2,000 profit on your $22,000 investment for a 9% return in the 2 months. That's a pretty good return. Again, there's a lot of upsides to doing it like this. So executing the trade is as simple as going to your broker, buying 100 shares of Facebook, and selling the August 21st $250 call. Again, I'm not making this as a recommendation. This is just an example. Now, the real fun of it becomes, again, 30 days later. You're going to go and examine the trade. So you could wait till it expires, and that's a 63-day period. But practically speaking, you want to see if you can buy back that call for a really cheap price or at least half price. So practically, you're going to want to close this trade, take the risk off the table, and then I would say once the call option has dropped, so we said you were going to sell it for $10. Once this call option is now for $5, we're going to go in and buy it back and lock in that $5 profit. Now, it could be 30 days, it could be 10 days. Somewhere in there, it's going to be that 50% profit will be available to you. Take it and move on to the next month. So that's basically my covered call strategy in a nutshell. I'm going to continue to do this. I'll do example videos when I'm making trades. Keep in mind, I'm not a professional. I'm an amateur. Don't follow me. Don't listen to me. I'm not licensed. Your options are risky, and they can be risky. So if you don't do this properly, if you sell the call without owning the shares, that's a naked sale, and you could be liable to deliver shares that you don't have. So there's some risk there. So be careful. But anyways, if you have any questions, comments, hit this video, subscribe to the channel. Love to talk about options with you, and see you again.